fundsupermart.com.
Over the last 12 months, investor concerns mainly centered on China's ability to engineer a soft landing for its economy. What were your views on this matter and how did you position the fund in 2011?
Well, China has gone through a credit, you can say, explosion after the Lehman crisis. So the banks were lending a lot in 2009 and 2010, mainly on the back of government policy. I mean, government wanted to stimulate the economy because there was a lot of concern whether the Western slowdown will have a major effect on, or major negative effect on the China economy. So the banks were being used as a vehicle to stimulate the economy through a lot of credit disbursement. As a result of that, inflation started to go up and property started to see some bubbles in some cities. And so 2011 was a year whereby the government had to rein in monetary policy, and that was what happened last year. To us, we're not top-down manager. We don't look at stock based on our view on government policy, on macro reasons. So we continue to stick to the companies that we know, the companies that have a very strong balance sheet. They are able to ride through a tight monetary policy. And a lot of companies that we have actually resided in Hong Kong. Hong Kong wasn't that badly affected by the credit crunch. And the reason why we buy a lot of Hong Kong companies is that they are much better run than the mainland Chinese ones. They do have a much stronger balance sheet than many of the Chinese counterparts. So to answer your question, no, there's no big change. We just stick with the bunch of very good companies. Yeah.
As we enter 2012, however, sentiment became more optimistic. Do you think the rally is sustainable, and are you making any changes to the fund's allocation in light of more encouraging news coming out of China?
I think the market has gone up a lot this year, especially for the two underperforming markets in Asia, that's namely India and China. We've seen a lot of interest in China and in the recent weeks, recent months, mainly on the expectation that the government will start to ease monetary policy because inflation is coming down, and the Western world is still very uncertain. So the government may still want to maintain a certain level of growth in order to maintain or in order to keep up the number of jobs that could be very important for the social balance in the country. As to how are we positioned, no change. We continue to stick to the companies that we like, and we do not base our portfolio on trends or on themes. I think we are optimistic in the sense that we're not optimistic that the government will loosen. I think maybe the market is a little bit too optimistic on that front, but we are optimistic on the valuation. Because valuation of the companies or the stocks that we have in the fund is now roughly 11 times, and that still provides a lot of value for the long term, especially if you have a long-term view. But there's no change to the portfolio construction here.
The fund has a 35.9% allocation to the financial sector as of its latest January 2012 fact sheet. Can you explain your reasons for this large weighting in a single sector?
Maybe just to break it down further, the 35% will comprise of roughly around 12 to 13% of financials, and the rest are mainly insurance, but a lot of it is actually 17% of it is quite a lot of it in properties. Maybe just to explain further here, the financials or the banks that we invest in are not the Chinese big four banks. We have reservation towards the big four banks, given what they have done in the last 2-3 years. It shows that they're still very much a policy-driven banks rather than a commercial entity. So that is, I think that proves why we have not invested in the big four banks for forever. I mean, since the IPO, we're not invested in them. For the properties as well, we do not have many in the residential side of property business, and we don't have many in mainland China. So we are not investing in the mainland Chinese property companies, but we're investing in the Hong Kong Chinese property companies, the likes of Swire, the likes of Sang Hong Kai, the likes of Hang Lung. So these are the guys that have exposure to China, but they do have very steady cash flow, a very steady base in Hong Kong that provides the cash flow for them to expand in China. But the main reason that we like them is that they have much more discipline when it comes to balance sheet, when it comes to capex, than the mainland Chinese counterparts. Yeah.